Generally speaking, the economies over the world are getting better. Now, we're not saying that we're looking at boom growth or anything like that, but if we look at the individual components, first of all, the US is getting better. We are looking at for above 2% growth for next year compared to roughly about 1.8% this year. Eurozone, which has been negative growth for the last few years, we're also looking at a positive GDP numbers for next year, albeit still at the margin, but the message is it's getting better. And Japan also, we are looking at above 2% growth for next year. So we look at the big developed world blocks, we are looking at an improvement. And if we look at the Asia region in general, we're still looking at Asia to grow at least about mid 6%. So growth in general is looking much better into next year. In terms of general developed market recovery, so we're looking at US, Europe, and even Japan. Generally, the exporter countries of Asia tend to do better when we have a better, stronger economy in the US and Europe. And this is because countries like Korea, Taiwan, and even to a certain extent China are generally quite export geared. And given where we are in terms of valuations today, in terms of equity markets in the North Asian countries, we believe that with export growth picking up into next year, which we believe is a very real possibility, and where valuations are today, I think the equity markets in the North Asian region will perform very well indeed. Well, in the very near future, always very difficult to predict, but we do believe that this is a very good entry point into the Asian market specifically. And the reasons why are a few things. One, they are very, very cheap at the moment, especially in North Asia. Now, one of the major reasons why it's cheap is that there are still, I think, concerns on China from global investors. But we believe that these concerns are, one, overdone, and secondly, it's all in the price. What are the concerns? The concerns are that China is slowing, and also there's concern on the financial sector. Addressing those 2 points very quickly, first of all, if we look at all the Chinese numbers that are coming out in terms of economic growth, we are looking at a stabilization of that. And I think as these numbers continue to actually be quite decent, investors will be more confident about getting back into China. Second, if we look at the financial sector, yes, there are problems in the financial sector, and no doubt that non-performing loans is actually higher than what is being officially reported by the banks. However, one, the banks are trading very cheap at the moment, roughly about 5 times. Yields are at about 6% odd. And there are some very concrete measures that the government has taken to address the banking sector, which the market has generally looked at very positively. So we do believe that the banks will be recapitalized in a gradual manner. Last point on this is that ever since the early 90s, I've been managing money in Asia, and many, many times we've heard, oh, that the banking sector in China is in problems, and there's going to be a financial mess, and so on. But time and time again, these problems have been addressed, and the banks have always been recapitalized without any major significant financial crisis. We do believe that this time will not be any different. For the reasons that I mentioned earlier on, we do believe equity is the right place to be, especially in Asia. And why is that? One is that we do believe that interest rates will gradually increase. Now, I stress gradually. We don't think interest rates are going to rise extremely sharply. But nevertheless, as interest rates go up, bonds will not be the right place to be in. Equity has been up and down, sometimes very sharply. So the volatility has to be addressed. Now, we have actually come up with an approach called the risk parity approach, where we do address the volatility issue in equities. What we have been able to do is that essentially by looking at stocks and weighting stocks and sectors that have much more lower volatility with a higher weighting, we actually bring down the risk of the product compared to the market. So in what we're doing with the risk parity approach is that we're able to deliver returns, we believe, which will be superior than the benchmark, but with lower volatility than the benchmark. So investors can hopefully, over the next few years, be able to get very decent capital appreciation in a gradual manner with a regular dividend income, however, with lower volatility than the market. The challenges ahead of investors is finding a product that has lower volatility, because markets are still probably going to be on the more volatile period. Secondly, in an environment where interest rates are rising, the ability to find a product that does generate a decent yield still, because fixed income will not be the place to be in. And also, as inflation continues to rise, albeit gradually, the ability to find something that has long-term capital appreciation. So investors do need to find a product that matches their needs, which is essentially at this point in time, finding something with lower volatility, but does generate decent income yield, but with longer term capital appreciation as well.